Test. Morning traders, welcome to the Traders Lab. I'm your host, Tom B. Can I please get a screen and audio check in YouTube in the Bookmap Discord community? Well, thanks everybody. Well, good morning. Thanks for visiting the lab today. I'm your host, Tom B., and I want to thank everyone who's part of the Trader Lab community for all their contributions and teamwork so we can all get better. The Trader Lab is a community of like-minded traders who've come together to leverage their collective experience. This is about the business of trading using Bookmap order flow tools, which Bookmap is a high-tier order flow tool to help traders see inside participant behavior. And this is aligned with a tool called the volume profile, which is a way to measure participant interest at different price levels. It is a chassis where traders can, shall we say, develop a trade plan in alignment with the participant behavior using a compilation of simple tools to reverse engineer structured trades and create a business or trade plan. The idea of the Trader Lab is to help traders understand the business of trading, how the market works, why it does what it does, and how at times you get in alignment with it. The key is recognizing when you have a statistical edge and not playing a video game or gambling. While we all take risk in trading, we also can get rewarded for that risk if we abstain from playing a video game and we only take advantage of opportunities where the statistical probabilities or opportunities favor us. And of course, just like the casinos, we're going to pay the gamblers. But if you organize this as a business and your objective is longevity and sustainability, then you might be able to further that objective in the Trader Lab. Now, have to take care of business, and we have a lot to talk about today. So we're going to need to focus. I'm going to move quickly, and you may want to review this stream. I'm going to afterwards or over the weekend because I'm going to move as quickly as possible, and I can't cover everything. General disclosure, all Bookmap Limited materials, information, and presentations are for educational purposes only and should not be considered specific investment advice or recommendations. Risk disclosure. Trading futures, equities, and digital currencies involves substantial risk of loss, and it's not suitable for all investors. Past performance is not necessarily indicative of future results. Please remember, this is not a trade calling room. If we get there, as they say, we'll talk. The process that I'm talking about here and sharing every day in the stream is how does the market work? It's called the auction. Purpose of the market is try to figure out what something is worth. Otherwise, who needs a market? That's why it rotates in all time frames. So if you're a higher time frame trader, you may think this is a bull market. Maybe it is. But if you're a day trader, we're going down in time frame and trading inside of other time frames. So think of a vertical integration. The behavior of that vertical integration or rotations is the auction. Now, the way we measure the auction is the volume profile. It's very simple. All it is price and volume. All prices are not considered equal. Think about it. If a price is priced too high, you're not going to have a lot of volume there, though somebody may pay it, but there's not going to be a line out the door. Now, if the price gets too low, you won't get a lot of volume there either. And you may say, well, why not? There's going to be a lot of buying. Well, no, because the sellers won't keep it on sale. Think about when you go to supermarket. If the price is on sale, you throw 4 in the cart, but it doesn't stay down there indefinitely. It tends to come back to retail or high volume. What is a retail price? It's really where buyers and sellers are willing to do business, and it creates volume. But when we move too high or too low or rotate around a fair price, then it either sets up a price where it cuts off buying or a price where it tracks buying, and then the sellers or the buyers have to adjust. Now, let's extrapolate that idea to multiple time frames. So rotations are happening inside of rotations. So as day traders, we can identify at times the rotations that fit our risk-reward ratio, and you can take that up to as high as you want or as low that makes sense to you. That gives you a statistical edge. Now, so that's your time frame. Now, context is what's the condition inside the time frame. And inside of multiple integration or vertical integration of time frames, this is where we operate. So theoretically, if you're in a bull market, we can be short today. Well, how can you be short when the market's going up? Well, today it's going down. Yesterday it went down, went up, and then at the end of the day came down, and today we're continuing down. How do you make sense out of that? Well, it's a great question. Guess what? You might find some of those answers in the Trader Lab if that's of interest to you. And of course, Bookmap is the order flow tool that helps us see inside of participant behavior. I call it the tip of the spear. Now, what about these structured trades I talk about all the time in the stream? Well, traders were asking me many years ago what I was doing. And all it is very simple. What I'm doing is, and I shared some ideas here, is I'm using the behavior of the participants, not what I believe or think. I'm aligning. And these are some ideas here. They're structured trades. And I never posted these with the idea it would be a trading course. It's not what I do. I'm just a full-time trader. I've been doing it 46, going on 47 years. Have a lot of background and experience, both professionally and otherwise. But I've walked in the same shoes you have. None of us are any different. You know, we all go down the same path. Now, these ideas are strictly examples. They are incomplete in the sense of I don't go into all the detail. They were just ideas, and you need to come to Trader Lab if you want to understand these, and you need to reverse engineer them. I always suggest that traders learn one specific trade. Why only one? Well, because if you can't do one, you'll do none. So the idea is learn the most common behavior in the market, and that's called mean reversion or trading rotations. Most frequent behavior is rotational trading. Now, there's a lot more information. There is no plug and play. Sorry to disappoint you. There is no shiny thing on the hill that it puts an ATM in the basement. Otherwise, we'd all have one. Doesn't work that way. So I'm just going to encourage you. If you find what you see here every day in the stream of interest, and you're interested in developing potential sustainability in this business and creating a career path, then Trader Lab might be a great place for you to visit, and there's no cost for it. Now let's get into today. I'm going to still try to go as quickly as possible. I'll do my best. And if it's not clear, which it probably won't be because of the speed, come to Trader Lab. There's a library of webinars, some up to 4.5 hours long of real-time narration, plus a document section, and the Trader Lab community that can put some shape to this. But there's no quick fix. There's no plug and play. And we all want it. That's just a manifestation of FOMO. I'm in a hurry. Show me how to do this. No, if it worked that way, we all would have our ATMs. And you're going to have to earn it if you want it. And then if you do earn it, you deserve it. Just like any professional in a highly competitive environment, whether it's sports or any profession, you have to earn it. No different here. You're competing against the best minds on the planet. And I've worked with them, hedge funds, quants. Believe me, these guys could do a mission to Mars with no problem. And they're here looking to take your dollars. So if you want to participate, then you have to learn. So let's not be naive here. Let's become a professional. Okay, this is the RTH Open. Now, we are opening. Let me find it. Slightly outside of value. Now, what is value? Value is where most of the volume took place yesterday. I got to show you yesterday very briefly. And again, this is going to be somewhat of an abridged version of what I like to do. But there were so many trades today that are structured trades in Trader Lab. And Trader Lab is having a great day today. Now, let's be serious about this. Nobody has a great day every day. But the reason we have a trade plan is because there's a random distribution of behavior. And that random distribution means there's going to be days where you kind of wonder what the heck. And then there's other days where you have a day like today. It's part of the random distribution of outcomes. So let's look at yesterday. This is what sets up today. Now, this is yesterday. Let me try to open it up a little bit. And this is called the volume profile, just in case you don't know. And don't let it, if you haven't seen this before, don't go running with your hair on fire. First time I saw it, I thought I was on Mars. Now, this is yesterday. This is the day before yesterday's low. So the market, if you look at day before yesterday, by the way, this day was long in the morning and we tested the previous day's low and we failed to get in the range. That failure sets up shorts, okay? And so we opened, went higher, failed, so longs in the morning, then turned the barge around, and then shorts. That's all wonderful. And down we go. We close here. Then yesterday, we open, we have shorts to take out. Now pay attention, outside day. Take out the previous day's low. Don't forget yesterday. Get shorts in here. And I got short early in the morning, which is fine. It's in yesterday's stream, following a trade plan. And then the buyers came. So look what you had. Shorts in here, new shorts trading, including moi. Then we came across the range, started coming across. I turned around, got long. And what did it set up for us? Let's look at how the market works. So I'm trying to remember. Yeah, up. Getting confused on which day is which, but I believe we went down first, then up. And then we squeezed. I think I'm getting confused on my days, so hold on a second. Let me just make sure. Yeah, I did. I'm sorry, guys. This is yesterday. This is day before. So day before, we went up, couldn't get in the range, got shorts, and then came down. Let's see if I got this right. Right. Then yesterday, came down, got more shorts, and the market is short from the day before. That sets up coming across the range, taking this high out and squeezing out the shorts. Market goes up to go down, goes down to go up. We took out the shorts. Now, this was really interesting yesterday, and this is what sets up today. And then look where we come back. After the squeeze, instead of staying up there, we come all the way back in the range, and the high volume, remember the shopping, was at 20, I think it's 25. That says everything above is too high, maybe. So now we have the retail price. Remember the shopping experience. Here, what happened to all this up here? Too high. And down we slide. It's like, ever go to a firehouse and they got those poles? Thing slides down. What does it say? Language. Too high. That's the auction. I'm not paying that after the buyers are squeezed out. So who become the buyers? The shorts. So we have built-in buyers and sellers in every rotation and every time frame. Now, this is the auction. I haven't even gone into the trades. I'm giving you the idea of how the market sets up. Now this is today. Now, let's get into today. So we open down here, and this is a value area, this here. Open right outside. So this is the RTH open. And this is yesterday's retail price. So the possibility is open lower, come inside. If this is too high, we can go down. So that I know. I don't know what it's going to do. If you know, send me a postcard. I know I don't know, and that keeps my mind open, not fixated on predicting. Years ago, we all start out, I don't know where you guys started, but I started out with things called measured moves. And it was very much thinking in a process of prediction. It's going to do this, it's going to do that. Hold on a second. I got a clear chart up here. Having a little trouble. One moment. I'm on a laptop in Mexico, and that, while it's a lovely thing to be in Mexico, it's not a lovely thing when you're on a laptop. So, such are the sacrifices we make, right? Let me try to get the chats back. I lose the chats. They get covered up with other charts, so I have to always try to get them back. So please accept my apologies. Okay. How we doing, guys? Okay. So this is our RTH open. This is 8:30 Central Time, the time zone I am in. Now, here's what sets this up. Now, let's remember the concept. high volume, shopper. This, which I just showed you, is the high volume from yesterday. So this is a possible test. Remember, if the price is too high, I'm not paying that. You leave the store, right? Well, we have the last auction is the ETH. This is the retail price from the last auction. Now, it can go anywhere, right? So we're not in the prediction business. In the Trader Lab, you were in the business of maybe. Maybe it'll do this, maybe it'll do that. But if you have structured trades, what you're going to be doing, assuming you've done the work and you have an edge for any one specific trade, and you learn how the market works, not predicting what it might do, you anticipate it. I have a little saying, and these were created for myself. You got to anticipate to participate. By the way, we have a target that we're just touching down here now around 43.75. And it's just a line on a chart, right? Maybe, maybe not. Remember, the best you have is maybe. So if we know this is too high, and this might be too high, that's all we know. And if we get through here, we'll just go to another level. Remember, auction market theory, not prediction. So what I'm doing here is I'm going, well, there's about an 80% probability. I'm not going to go into statistics. I'm just going to give you the broad strokes because of time. But when we open lower, where am I here? Hold on a second. Inside a range, getting up here is about 80%. There. Getting to the point of control, the one above us, is about 68%. So the highest probability nearby statistic is right here. Okay? If you're in Trader Lab, you'd know that. Now, if you're in Trader Lab, you also know you don't know what'll happen. So let's get over it, okay? No prediction, no being right. What is right? Executing your trade plan, not the outcome of the trade. Get over it, please. When you need to be right, that has nothing to do with this. Needing to be right is psychological and ego and getting your self-esteem validated. Wrong business for that. Get it elsewhere. You can't get it here. So, market opens. This yellow line is called developing volume point of control. What it is it is the current retail price. Now, what this says is it starts at zero. And when the market starts trading, chop, chop, that's an auction. Too high, too low. So it's an auction. So it's a consolidation. That's all these things are. But if we leave a price that says, let's go back to the shopping experience. Maybe this is too low. No, I don't know. Do you? I don't know. So maybe it's too low. Maybe it's not. I don't know. Do you know? Here's what I know. I have about an 80% probability of going here and a 68% probability of going higher. What else might I know? That's called the full session VWAP. That's kind of interesting. And it's in alignment with my overnight volume point of control, which has an 80% probability. And I have the developing volume point of control here. And we have a trade in the Trader Lab that I always say is the primary trade for traders to develop and reverse engineer and vet. That's called mean reversion. The trade you will see most of the time in all time frames is something called reversion trading. What is this reversion? It's what's too high, what's too low, what's fair. Remember the shopping experience. If the price gets too high, now I don't know where that is, and we run out of buyers, and I'm using order flow, and I open this up at a location that has a probability. What am I going to do here? How about nothing until I see, and by the way, ETH low, there's over a 90%, almost, about a 97% probability I take out the first, the ETH higher low. Pick one. But what do I know? I know this is the fair price from the ETH. Now, why am I spending time here? Because the market is speaking if I know how to interpret the language. I don't use indicators. And I'm not saying you can't. I don't. And the reason is an indicator is one-dimensional, price, and some derivative of price, something. Okay. Well, what is this? This is shopping. This is the valuation This is how we can measure sentiment of the participants. And if in the ETH, this is a fair price, what happens if we open and we come up to the last retail price? Remember, you went to the store, you bought your can of tuna, it was $1, but now you come back to your favorite shopping and you say, this is too high. I don't want to pay this. And then the shoppers, who are the traders and the participants, go, I'm out of here. But how do I know this might be too high? Statistics and what it represents. Retail price, last auction. And what else about it? It's lower than yesterday's, which is here. Maybe it's too high. So VWAP, what's the reversion? Coming back here. First trade's a short. Who knows? Me? No clue. I'm leaning against this to go here. This is mean reversion. So the idea here, this is your trigger. You can sell it there. If you're fast, you could try it here, but this is much better. And these are trade locations, microstructure, and it's right there. That's high volume in a micro, in alignment. You see the alignment? Let me show you this. This is why I don't have enough time, because I'm going to try to break this down for you. This is where the micro is. So I get sellers here, no clue, by the way, and buyers are here. Break low. Right here, maybe it's too high. But what do I have? Alignment. This is what you need. Alignment. Break low. Now I see mid and VWAP. Right here, I think my trade's going to fail. I got my mid and VWAP buyers. Going higher? Oh no, there's my stop coming. Isn't that what you think? But what I've figured out over too many years of bailing out right here, so I could save 2 ticks or 3, is that the trade hasn't failed. And my stop is not here. It has to be further away, because it could come up here, take the buy stops out, and then get these sellers absorbing. Don't know. Do you? Nah. So I don't know. So if you don't get short here, you got this. So, and when you see this and the absorption with order flow, you can sell it. And it's a reversion trade. It comes back. VPOC migration. Now, this is a specific trade in the Trader Lab. Let me explain it. And again, I'm getting all hung up here right on the open. Look at the trades. Why am I even going over this? Because there's language. I'm not using indicators. The market speaks. You just have to learn a foreign language. Maybe that gives you an advantage. What do I know here? Too high? Too high? I'm out of here. Mean reversion. Now, right here, this moves up. What does it say? What's the language? This is the fair price from the ETH. Right here, 2 possibilities. If this is too low, we're going to blow up to the outside and we get stopped out. But what else? If it's still too high, we break low. If it breaks low, that's another structured short in the Trader Lab, and you're still trying to go here. And then ETH low. So that's how this thing starts there. Okay? So this is a short. So this, here, scale. Here, teeth chatter, break, another short, scale. Watch. Notice the behavior right here. See it? Why? This is a retail price. Oh, it's on sale. Too high. If we lift it off from here, because it was too low at the time, and now this is too high, does it make sense to this astute group of traders that we might come back and check too low? Right there. Okay? So if you're short, you're going there. If you're short, you're going there. Same thing, same trade. This is mean reversion. Now, to get your brain spinning, because I know you would feel left out if I didn't get your head to roll a few times. What is this? Same. Going from here to there, this is a mean from the ETH. The long from here, which is not a long, is a reversion trade back to high volume. When we find a price that's too high, we're going to revert to what might be too low. If we find too low, we can revert back to what's too high. If we find too high, we can revert to what's too low. And based on yesterday's RTH and the failure and coming back in the range and the failure of not getting to the retail price above us here, not getting to the ETH mid and only getting here, which says too high, too high. What do you think? Reversion to there is reversion to there. And if we get under here, which is now our support, you see it there, rotate, break, subject to your vetting. This is a short right under here. Come back, watch. So you have a potential short here. You have a potential short here. Your stop has to be above where it was what? Too high. If you break here, you have a potential short there. Stop has to be above too high. These are a little advanced. Target is ETH low or this liquidity right here, subject to your frame of mind or lack thereof. Break below the ETH low. And then we have the stops under yesterday's low. Thanks for playing. They get a coupon to the buffet. Now, when we break yesterday's low, so all these are structured trades. Some of them are a little bit more advanced. Okay? Let's watch. So buyers are here. Now, right here, and the target was 73. All this is posted in TraderLab. So for me, this was the primary target. And at this point, it's either we're done, or if I get below this, it opens the door to 40. Let me give you the targets down here. 43, 75. This is posted. And I think, no, it's 74 and then 43. And this is all in higher time frame. Now, remember the shopping experience. VPOC migration. What do we know? We know this might be too high, and we know this, yesterday's low. So if we hit our target there, all this is on the chart, and it's in TraderLab 73, then where did we have our buyers? We had them here, and we broke low, so that's one area. We had them here. Let me see if we traded here. They pulled, okay? They pulled. So we're going down to target. Now, let's think mean reversion from the other side. This is the mean that was left behind and also a higher time frame. If I come down here and it's too low, I can revert up. And if I come back, I can check yesterday's low or just pull outside. Remember, don't know where. Part of the thrill of not knowing. And watch. So this is reversion. I'm showing you mean reversion. Underline the term mean. If you understand reversion trading, you understand a lot. You don't need, in my opinion, anything more than this, because this is the language of the market. Now, this is the new retail price. Watch. What are the possibilities? Well, I revert down here, and if this is too low, I then can rotate. The other part is in the developing daily time frame, this is the new retail price. So you're going to say, Tom, last time it broke below, you sold it. Why wouldn't you do the same thing here? The answer is no. Why? Because this is the target. Then there's a couple possibilities. I'm outside of yesterday's range, right? So what does that say about valuation? We're rejecting yesterday's valuation. Well, what might we do if this is the fair price now? Well, maybe we'll come outside, and if I come, let me show you this. I'm still talking mean reversion. That's all you need. And a plan. and an edge, of course. But once you learn reversion trading, this is what the market does. Now, the trick here is yesterday's low and an outside edge. Remember the shopping experience. This is retail, high volume, buyers and sellers agree. But if we counter rotate, and why do we get buyers here? Well, there's buy stops, right? The market's doing the Acapulco cliff dive. Typically, it's going to pause, and the current shorts in the market are going to get squeezed. The joy of joys is to where? Well, guess what? We don't know that. But you know what we know with the auction? We know that out here, we accelerated, and that creates something called the low volume node. The other thing we know, the reason we accelerated was yesterday's low was here, and there were sell stops. When you go through sell stops, that's acceleration. They become market orders. So it leaves an outside edge. So if this is the fair price, remember the shopping experience, and I come outside into this area, I might find sellers. And if I test yesterday's range and I don't get back in, I can continue and at least return here. That's called mean reversion. What you're seeing happen is coming here in a higher time frame was reversion, and then coming out here, if it comes here, is reversion. So it's always the same reversion. Okay, so this is a trigger right here. So it comes out, jaw flapping in the wind. Who knows? Tests yesterday's low. Logical? Is it? Break low, trigger. How do you get into this thing? Well, we got buyers here. We got buyers here. We got buyers there. We break below. What happened to these buyers? Thanks for playing. You get a coupon to the buffet. Trigger. Your short is here. Your scale is there, because this is called mean reversion, different time frame, and then you're looking for it to continue. Okay? Also, at 9:30 Central Time, which is not quite yet here, we have something called the IB. First hour's high or low, called the IB stat. And I don't know about you, but there's about a 98% probability we take out either the first hour's high or low. Raise your hand if you think it's going to be the first hour's high. Okay, I don't see any hands. So what that means is we have a 98% probability of taking this out. Does that mean you want to get long, or does it mean you want to use rotations to get short? So that's why this is a short, because we're going for 9:30. And who knows? Watch. Come out. So here's what this would be. A short here, a scale. Going for this at 9:30 Central Time. We're sitting around 9:15. Who knows? Doesn't have to. It might. Clueless. Well, on this one, you would scratch. Your scale is here. Your stop would go above here. You get taken out. Life in the fast lane. Now what? Where's our next location? Well, we have mid and VWAP right here. And I posted in TraderLab to be cautious, because if we come inside yesterday's range, there could be trouble, because we don't know how far it might push in because it's squeezing. But it is a structured trade. Now, the problem with a structured trade is these are not mechanical. This is part of the challenge of trading, in the sense of there's no plug and play. In the auction, or the way the market behaves, is these are areas of behavior. Okay? So let's look at this. Now, we're getting buy sweeps. Now, in fact, let me mention a few other little things in here. See the sell sweeps? Not material to me. Sell sweep at a rotation is material. That's just potentially to rotate up. A buy sweep at the outside edge of a rotation suggests a rotation down. Now, I'm at VWAP in mid. This is our structured trade. Now, it's not mechanical. I always say, and this is always a tough thing for all of us, I always say to our traders in TraderLab, think like a retail trader. Don't act like one. And because right here, you're going to get mechanical selling. The other thing we know is their stops are going to be here, because as retail traders, we're typically risk adverse. Why wouldn't you be? We're wired for that. So if you short here, there's a reasonable chance you'll get a rotation, a squeeze into stops, and then the actual move, or none of the above. It can do anything. Remember, it's random. So let's look. I'm getting my sweeps. So here, if you took this mechanically, you would probably take a stop. That's fine. That's part of trading. It could just as well do the Acapulco cliff type. By the way, if you take this trade, the structured trade, the goal is to come back here. Same as this, different location. This is called mean reversion. Well, this trade is also a reversion trade. And based on the direction of the market, with at 9:30, over 98% probability to go here, short somewhere. So let's look at it. So here, if you take a short, I'll tell you, I took a short right here. Right here. Right here. Now let me show you how I work this thing. Now this is hard. And the reason it's hard is I'm outside this. So my next outside edge is out here. And I have the ETH low. So I put this thing on, actually it was here, and then I figured, oh, I'm going to get stopped out. Because I thought I had gotten them, and I had this liquidity. You see, I had this, I said, okay, I got back up, I got my sweep, I put it on, and right here, it was dubious, So I looked out here, and when I was looking at it, and I have a level here, and I have an LVN, and I have the ETH low, and I got the full session VWAP. So I took a wide stop on it, and the reason I put a wider stop out for me, and it's not a big deal, it's really not. It's in my risk parameter because of the risk reward. I will adjust based on range. If I'm using a micrometer, but anyway, in this one, I was further out because I have confidence in the statistic. So I was trying to stay in here to get here. So the trade is put it on, and it has to fit your risk reward. If I take a trade and get stopped out, I'm not that concerned. I am emotionally disappointed. I am not concerned. It's just because I accept it. Don't like it. I have an emotional response, annoyance, maybe anger, whatever, disappointment, because we're all cheering for our team, right? But it doesn't mean that I don't take whatever. I just put the trade on because I have confidence over time in the outcome, not of a specific trade, just as what trading is. So the short from here with this backup and out here, the goal is to come here for a scale, and then this is the high probability, and then I have a target below. I do have to get below this too. Remember, this was my target coming down. All that's in TraderLab. So now this is the actual trigger, much nicer than where I got it. Let me show it to you so you can see it. Now, this was me, okay? But this is much better. In hindsight, of course, everything's clear. The buyers are here. The sellers are here. Now, I'm figuring here, you see, break. So break. Now, this is where the buyers were. This is the mid and the VWAP. This is your trigger. The sellers take control. This is the outside edge. You'll see the test there. That's a short. The test here, that's a short. And the stop needs to go there. Structured trade. We can go a little further. There, there, there. These are all entries here. Stop needs to be here. It's all subject to going there. And then out the bottom, 930. Remember, 98% probability to get under there. And 43, by the way, is the actual target down here. VPOC migration, too high. Now, this is the new retail price. And we have this liquidity sitting here. And this was pointed out in TraderLab. One of our traders goes, this is the wall. And it is, because 50 is a strike And who knows? Now, my target, when I say mine, the auction's target for me was here. At this point, I was like, if we get here, I'm good to be done. It doesn't matter to me. So this was my target. This was it for me. I get a sweep right at the target, and this sets up the counter rotation. Anyway, this is where I was done. And I just put a target out. Oh, there we are. Okay. Now, that doesn't mean it's the low of the day. It's just the target, and it's created by the auction. Sorry, guys. And there's other trades in here, but they're more advanced. Okay, so now we're in real time, but I have to show you how this works. Now, if you want to see real-time narration, which everybody always says, do real-time narration. Well, I don't call trades. I take stops. You take stops. What's the big deal? But there's recordings in the Trader Lab. You can all access it at no cost, as well as the community that are up to 4.5 hours long of real-time narration. You can get your fill. Hold on one second. I got to turn some levels on here from Investor RT, which is what my higher time frame software is, and it exports levels that will show up here. Very nice. So this is the current retail price. This is our outside edge. Low of the day. Who knows where the low of the day is? Do you? I have no clue. I do know this is the retail price. I do know I can return to this, but we can also, now let's remember how the market works. Market goes down to go up. The shorts now have stopped sitting here. So it's possible that I can come back and squeeze these guys. You can be done for the day, Now, the next trade we're going to be looking at, and these are not recommendations, we have to see the behavior, is here. Out here, outside edge. This will be a low volume node right there. That's the lowest volume. And let's remember how the shopping experience works. We find too low, we can come back to retail, and then we can go where's too high. Well, I know 73 was a target coming down. Maybe it's still too expensive. If I come outside here, this is called what? Mean reversion. And the possibility is to rotate back here. So this sets up here a potential short. And why also might it be a short? Let's come back and look at a couple other things. Just letting you know, when you have a trade plan, you can't predict anything, but you know what you can do? You can anticipate. Let me show you something else. Tell me if it does not make sense as a shopper. Now, you're a trader, but we're really just shoppers. Did you know you were a shopper? I know. We say, what do you do? I'm a trader. No, you're not. You're a shopper. This was the first hour's low. We have a trade called the IB continuation trade. And what it is, if we know the stops are above here and above here, and out here, it was like, I'm not paying that. What might we do? Mean reversion traders. We might come back here to this outside edge, and then the shoppers may go, I'm not paying that. And where might we come back? To the fair price. You see, that's called mean reversion. Now, it's not a trade recommendation. We have to see the behavior if we come back up. But if we do, that sets up the reversion. So that's the same behavior I've been showing you. So the idea is if we come out here to the IB first hour and the outside edge, we can go, I'm not paying that, and come right there. If that works, this area, remember, no precision, and it's the VWAP, we can come here. That's not terrible. What do you think? What is that, over 10 points? 15 points, subject to what the condition is when we get there, not a recommendation. And then, if we get under there, the possibility is to come down. So this trade is already part of Trader Lab. Whether it's going to, come to fruition, no clue. Not my job. But I already know where the trade might be. Does that make sense? And how are we doing? How you guys doing in YouTube? Thanks for visiting Trader Lab. This is about the business of trading. No holy grail, sorry. Where did the 4375 come from? That's an intermediate time frame called a micro composite. It's there. If you look at how this tends to work, these are high volume areas, and this is a composite profile. This shows all the volume that's ever happened up here. There's the high volume there. Too high? Let's go shopping. We leave it. We come back up from below. And now as you go in a higher time frame, there's more slop, Then where did this 74 come from? Great question. Where was it? It was here, 74. We're about the 4375. It's coming from here. And it's also, now this is filling in, but it's the low volume area in here. So it goes high volume. Here's low volume, high volume, and low volume is out here, right there, 4375. So it's a low volume area. If this thing keeps going, we have a high volume area down here. Now, not my job to say what it'll do. My job's to align. And then as we come down, I look back to previous areas. And this area down here was too low. So if I get into the stops down below and I find exhaustion, which is right there, that might be the end of it once I get the sell stops out, because now we have sellers, and if that liquidity gets absorbed, I can come across. But for me, this was my target. It doesn't matter for me, at least, what it does. I just get in alignment, get my piece, follow my plan, and then whatever it does, it does. And that's all I have to do. I have to follow a plan. I can't predict what it'll do. I hope that answers your question where it came from. And there's no precision in this, and there's no prediction. I mean, it can do anything. It can never get to these levels. It can go past the level. It could do whatever. Are we now in a bear market? I'm getting a question. I have no idea. I don't trade that time frame. Maybe, I'll tell you, in hindsight, we'll certainly know. But right now, as a day trader, I'm only trying to align with the intermediate time frame and the daily developing time frame. That's about as deep as it goes. Whether the higher time frame, are we going to come back and squeeze out the shorts now and make a new all-time high? I don't know. So, but I don't trade that time frame. I know we're the higher time frame's a bull market. And I don't know, what is it going to take? Theoretically, what? We get under the 200-day moving average? Yeah, that's useful. But in the meantime, I'm getting a question, should I liquidate my portfolio? Hope not. Ask your advisor. They know, right? Doesn't your advisor know? Should you liquidate your portfolio? I have no clue. That's a question for your advisor. If it's securities, you got to ask them. Lost the chat. Sorry, guys. Okay, sorry. Exactly. Popeye. Exactly. Matt, did I answer that 4375? Yeah, it's an outside edge of a higher time frame distribution, but there's no precision, and we had stops under this low. This is important. So we didn't quite get there. So doesn't mean we won't. I can tell you I don't have any longs, not now. And now here's an interesting thing. There's traders and trader labs are going to be trading long, short, and whirling dervishes. I'm not a whirling dervish. I'm just a dervish. So I don't whirl. I found, now you have been a high volume NQ trader, 100 trades a day, that kind of thing, many years ago. And I was put in a situation because of my volume that I was going to have to go lease a membership. I wasn't going to buy one, to lower my costs. And figured it out, less brain damage, lower cost, larger rotations. Also, the volatility was less when I was doing this. I mean, it's still NQ is very volatile and very thin. It has its own problems as far as the adjustments you have to make to operate in a thin market. So I kind of went in the other direction. Less trades, more range. So the cost wasn't material anymore. What was material to me was changing, and it took me a while to change. It was funny. I started out as a trend follower, position trader because I was managing money. And that was really position trading. And back when I started in 1980, day trading really, we didn't have the technology. It was analog. You would write an order on a piece of paper and timestamp it. Pick up the phone, call your guy on the floor, timestamp it. Get your fill back, timestamp it. I mean, think about it. So anyway, that's where it was when I started. So day trading didn't exist. Short-term trading for me was swing trading the large S&Ps, not the minis, and certainly there were no micros. So it was all different. So anyway, I'm just saying as the technology evolved in 2000 and changed, I was trading going into the dot-com crash. So the dot-com crash was a very interesting time to trade. Neither here nor there. But so I'm just saying but in Trader Lab, we have people and traders who will trade both sides of the rotations. I have found for developing traders, and even including myself, I just want to align with the dominant side. I don't want to align with the short covering. So when I look at this and I'm thinking, who are the buyers? Do we have longs buying or do we have shorts getting squeezed, the weak buyers? I have a perception, and I'm not saying, and it's only for myself individually, not you, me. And that is, I only want to take shorts today. So I use the counter rotations as squeezes for continuation shorts until the condition changes. It hasn't changed. So some traders may try to buy this. Me, I want to use whoever they are, which I believe are the shorts in this leg getting squeezed, for continuation shorts to their reversion. Now I get VPOC migration. What's the language? No indicator. I'm not paying that. Well, now, new retail price. What's it tell us? Let's look at the language. Let's go to the store together. This is what the market really is shopping. Well, I'm not paying that. You got to be kidding. Are you sure? I'm not paying that. Trigger. Now, this has to be vetted. It may just as well come across and squeeze. That's the unknown. That's the risk. That's also life in the fast lane. Outside of yesterday's range, 73 was a key price, target coming down. Where are we relative to 73, you ask? Where are we relative to 73? Well, we're below it. Now the retail price is here. What's the language? Speak a foreign language. I'm not paying that. What does that suggest? Lower. And where's the stops? Here. Where are we going? Into the stops. Why would we go into the stops? There's longs. And we get under here, where are we going? I have no clue. How do I deal with that? If I'm short, subject to time frame, I'm managing the trade because I can't tell you anything other what it might do. I have a sweep here. This suggests the potential for counter rotation. Sweep here, potential for counter rotation. Sweep here, potential for counter rotation. Sweep there, potential buy sweeps, down. Sell sweeps, up. I don't know. Liquidity, down. Sell sweep, up. Buy sweep, no. Where? Buy sweep, location, down. Sell sweep, new low. Stops. Now what? We have to watch here, not for a long, for a counter rotation. And it doesn't have to do it. You'll see these things and they go, yeah, right, boom. Or you see it here. Why didn't we go down? Because we went up. All right. You can't, it's not one piece. It's a confluence of pieces in alignment with the trend. What I was saying before is I'm not a whirling dervish. I'm a dervish because I get aligned with the dominant side, and I use the squeezes and the counter rotations for continuation trades if it comes to a location that I've vetted. I hope that makes some sense. So this is not about chasing the market around playing a video game. This is taking intelligent risk for reward. That's trading. And to me, fading a day like today is not intelligent. And randomly, we all have winning trades no matter what we do. If you had a magic 8-ball, we used to have one on the trade desk, and you'd say, should I get long or short? It says ask again. And that is as good as anything. If you had a random buy or sell generator and you pushed it, you didn't even know, you'd still have winning trades. What does that tell you about your process? If you're leaking equity in spite of the winning trades, which is all of us, then it is not your effort, it's your process. Gamblers win in the casinos. Casinos pay the gamblers. Well, we pay the gamblers too. But do we want to sit with the gamblers, or do we want to sit on the house side of the table? The house side of the table is playing structured games that have a statistical edge that favors them. And they pay the gamblers. It's called cost of production and overhead. We don't experience it that way. We have this whole psychological need to avoid risk and get confirmation so we can be, quote, right. What does that have to do with this business? Absolutely nothing. Where does that come from? It's a psychological need. All right. You got to learn about yourself. You have to learn about the decisions you make and where they come from. They're not based on the business, guys. They're based on a psychological need for validation and approval and a validation of your self-worth. I have to tell you, this is the wrong business for that. The evaluation of yourself comes from being able to follow a trade plan. The trade plan is not a video game in a random environment. It is structured trades that you've vetted that have a statistical edge in a random environment. But the idea of a statistical edge is that over time, even though you're going to pay the gamblers, which as we experience it, a losing trade, but maybe it's not a losing trade. If it actually has an edge, it's just part of the random distribution of outcomes. How do you change your experience? Well, over time, you've got to learn the business you're in. The business you're in is not a business of being right. It's a business of executing an edge. You can't be right with every trade. There is no right. There's only edge. It's very different than being right, isn't it? Part of the trading business is measuring your adhesion to an edge. The casinos don't change the game because they pay the gambler on the last hand. They just do the same thing. Because the casinos only control how they play the game. Once the card leaves the deck towards the gambler, the control that the casino has is gone. So their control ends there, and then they're in the same environment we're in. Completely random, 100% random 100% of the time. Instead of looking for predictability, which is our nature because we want to avoid risk, we have to look for probability. Isn't that a different thing? So we try to build for ourselves confirmation, right, to avoid risk. I know I did it early on. It was get rid of the risk and get more certainty. Very logical. But what happens if you can't get rid of the risk, but all you can get is probability? That's how the casinos built their empires. I think it's a good business model, don't you? By the way, stops. Now we got the stops out. Now we look at the iceberg starting to go off down here. They're the passive side. So they are absorbing. And what do we need? Look at the stops, 959. This is a stop and iceberg detector. It's giving me additional insight. 800, 1,000. Ooh, who's long? Intermediate time framers, right? Well, we're day traders. So when you see these stops coming out, You see the other side. These are the limit orders. Those are the icebergs. And this is the tip of the iceberg, right? So they're absorbing this liquidity. The icebergs need the sell stops or market orders. Remember, if there's a market order, it shows up as delta. There's your delta. And that market order is met with a passive order. You got to have the passive side with the market order. You can't have market order, market order. Market order buyer, it's not going to work that way. You're going to have a market order buyer. Now, these are limits with a passive seller. Okay, so these are market orders coming out. There's the delta and passive buyers. So this is absorption. This is how order flow can help you. We see the sellers. We see absorption. Very important. Now, what do you see here? Less selling, lower price. This is divergence, delta divergence. Kind of see this, right? Now you see more buyers here. Now, it doesn't mean it's the low of the day, but do you see the potential change? If I understand market mechanics, and I understand there were stops right there, and I understand the sell stops are here, and I understand that these icebergs need that liquidity, can I anticipate behavior? Here's the other thing. If you understand how the market works, which you can learn in Trader Lab, might that give you an edge? Or at least the ability to anticipate in order to participate, to see behavior and maybe manage a short if you were targeting this, which you could. Now, remember, we talked about 43 as a target. Doesn't mean it's anything, except we know there's stops. If you know there's stops, you could be going for the stops under here, or you could be done with the trade here. Does it matter? Doesn't matter to me, but might matter to you. So, are you still, if you were trading to this trade and you understand market mechanics and you can read the order flow and the change potentially in behavior, what would you do about it? You see? Is this making some sense? Dimitri, if you want to learn this process, you can come to Trader Lab. There's a link in the bottom of YouTube. There's no cost to participate in the Trader Lab community. So you understand what Trader Lab is. It's a group of like-minded traders who've come together to leverage their collective experience. It doesn't matter how long you've been trading, and this is for everybody, or what you do. Doesn't matter. What matters is, if you're like most retail traders, in spite of these random winning trades, which we've all had, everybody, and our theory is, by the way, as developing retail traders, because we have random winners, don't forget, gamblers have winners too, that if we just make it better, more winning trades. I get it. But the way we typically approach it is curve fitting. So we look back and you say, boy, if I would have got that 20-point trade, let me throw my something, my stochastic, my envelope, my moving average, my Fibonacci, Elliott wave, whatever, Open up your toolbox, your software toolbox. There's almost 200 indicators in there. There's if I drag my investor RT on here and opened up, there's so many things in there. I remember them over the years because as those indicators were being developed, I was digging into each one of them, understand them, and maybe take ideas and customize it. I built trading systems, and a lot of this was new. I spent years looking into it because they all made sense and they all worked randomly. I call that the catch-22. Everything works. But if it doesn't have an edge, it doesn't matter, So what we do is typical retail traders. We see what works. We try to put it together. We do a little tweaking, get the screwdriver out. So next time we'll get it. I could have got that 20-point trade if I was using a 9 EMA instead of a 20 SMA, whatever it is. Well, that doesn't work. But you are going to have random winning trades, but you're always going to look backwards to look forward. It doesn't work because the market is unique. Today is not yesterday. How do you build a solution for days like today based on yesterday? You can't. So if you can't, But our nature is, since we believe that's what our job is, that's what we do. And unfortunately, what happens is, in spite of the random winning trades, we're leaking equity. So over time, you're still losing, but the intermittent winners keep you doing the same process. So you always wake up with something I coined for myself called Trader Groundhog Day. Work hard, wake up in the same place. So at some point, the light bulb needs to go off. You have to say, I'm working hard. I'm all over the internet. I'm listening to all these influencers. I see the thing that says the only one thing you need to make $1 bazillion, and we're all attracted. It's like a fish coming to a shiny lure. And those are marketers, and that's great. I'm going to tell you, don't bother coming to Trader Lab unless you're ready to work. And unfortunately, instead of trying to bend the market to your psychological needs, which is to be right and get predictability, you're going to have to change your beliefs, because we come into this business with things that work in the outside world. So we believe we just apply it here. It's very logical. We've all done it. But the thing about trading is it's a different environment. You might as well be on Mars. The laws that work in the outside world that have gotten you to where you are today, and presumably successful to be able to do this, are not the things that work here. And so to change that, instead of bending the market to fulfill your psychological needs of certainty and risk avoidance, you have to learn to bend yourself to the market and accept randomness and uncertainty and not wait for confirmation. I was mentioning something the other day, and one of our traders in Trader Lab pointed it out, and I thought it was a good thing. What it was is, when you look for certainty in a random environment where there is no certainty, you increase your risk, but you don't increase your certainty. When I put a trade on, I'm uncertain. When you put a trade on seeking certainty, the chances of that trade being profitable with more risk is not any better than my trade with less risk being profitable. The randomness is equal. You have only increased your risk seeking certainty. So what does that do over time? It doesn't give you certainty. It gives you more risk. How does that work in your favor? You see? So our nature, our psychology is actually working against us. So one of the things you have really no idea about until you really drill into it is to understand the decisions you make and what's under the hood driving the choices you make. On the surface, it seems like logic and common sense, and it actually is outside of trading. But in this world, you might as well be on a different planet, because you're in it. The oxygen is different. The gravity is different. The whole behavior is different. So you're guided by your primal wiring, which is to avoid risk. And that works good for survival of the species. It's very logical. Is there a saber-toothed tiger behind the rock? Let's wait, be sure there isn't. Well, when you're right here on the hard right edge, is this a long? Should I get out? Am I looking for a short? What am I doing here? Let's be certain. Well, there's no trade here, by the way. But we do know where the next trade might be, out here. So what happens when we get there? What are you going to do? If you're in Trader Lab, you don't know what the outcome will be, or even if it'll get there, or if it'll just keep on going. But you do know, if in Trader Lab, that if it comes out here, then you know what a trigger looks like. You'll know where your stop goes. You'll know if the trade is vetted by you, so you have an edge, but you'll never know the outcome until you put the trade on. Our nature is to wait for confirmation. Then the market might, if it is going to work, you'll say, oh, it's going to work. Look at that. It's already moved this far. I'm going to put it on and go here. If you're in Trader Lab, you're going to put it on out here with just as much chance of it working as you putting it on there, except my risk will be whatever, and yours will be twice as much. How do you think that turns out over time? Just think about it. If you can't have certainty no matter what, then you have to accept uncertainty. And the way to deal with uncertainty is statistics, tangibility, not predictability. Isn't it a different thing? Now, this may sound somewhat esoteric and maybe almost philosophical, but it's actually the business we're in. The gaming business is this business. If you want to look at a business model that's proven, it is gaming. And the games that the casinos play, like blackjack or any other game, are played exactly the same way. They do something, they use an anchored input. So what's an anchored input? Well, outside here, that's a structure. It's a structured trade. If it gets here, then we have a trigger and it's anchored because we know this is a statistical edge. We don't know what the outcome of this trade would be if it gets there. And it may never get there, or it may just come at the end of the day, and then you might not take it because now the shorts will cover and they become the buyers. So there's elements to this. So in your trade plan, you have specific rules and specific trades that are qualified in this context. This is called context, which is, I'll see you later. I'll send you a postcard from the edge. On different days, the same trades are not qualified. Most developing retail traders have like a generic process. Always sell the mid, always do this, always do that. But today's not yesterday. You see, today is unique. So you would already have a plan for today. You wouldn't know what today was going to bring, but as it develops, then it qualifies certain trades. Longs, at least for me, are not on the hit parade today. Other days, it'd be long reversion trades back here. But for me, so far, and it's not a recommendation, I only have short reversion trades. So the reversion coming back is not a long. If I come across the range, remember where my stops are sitting, here. If I come across here, I'm looking at here. If it comes across here, I'm looking up at the mid and the VWAP and this outside edge. You've already heard it here. Now, does that mean I'm mechanical? No. It means now I have to read the order flow, look for a trigger, put my helmet on, and be willing to give a donation to the Floor Traders Retirement Fund and take a stop in order to come here, which is my trade, and then maybe test the low of the day or not. That's just trading, guys. That's about it. Does that make sense? Even if you find this interesting, use the link in the bottom of YouTube. There's a library of webinars and the Trader Lab community. It's all available at no cost, as well as a lot of additional education in the Bookmap server. Stocks, options, crypto, order flow with a high tier tool like Bookmap, market maker behavior, algorithmic behavior, and tons more. Additional streamers, of course, the Trader Lab, which is available to all of you at no cost. And this goes on and on and on. So this is the Trader Lab. Now, let me show you one other thing. This pinned in the Trader Lab is a library of webinars. The primer webinar has about 34,000 views. It's from 2021. Remember, I'm not a vendor. I'm just here trading like you. I've been doing this since 1980. I take stops. There's no magic wand, guys. We got to get over it. There is no secret sauce. This is shopping. If you know how to shop, you have the basis of trading. All we're doing is shopping. And the thing about shopping in the market here is that it's happening in multiple time frames or rotations. The inputs, the way this works is anchored inputs. So the idea of an anchored input is that it's somewhat process oriented. Well, I built trading systems. They were conditional. What is the condition? That then qualifies certain trades. If the condition changes, those specific trades might not be qualified in the current condition. Then different trades are qualified, or no trades are qualified because I don't have an edge under certain conditions. Does that make sense to you? Do you think the business of trading is a video game and you're chasing the market around? That's a recipe for see you later, thanks for playing. You get a coupon to the buffet. You ever go to and a cocktail, by the way. Meet the Traders Lab. This is an advanced trading methodology. Now, when I say advanced, I have to tell you, it's not really complicated. The advanced part is you actually have to learn how the market works. It's not your indicators. Your indicators are not the market. They are derivatives of price. That is just one minor element in a basket of behavior. You need to understand the behavior in order to deploy an indicator. You'll also need to understand when you're working with your indicators and curve fitting, you're trying to isolate a condition of the market in an environment that's constantly changing. So what you get is, sometimes you get those winning trades, But what about the rest of the time when you're getting chopped into oblivion? The reason it happens is the indicator is not context specific. It's just rotationally or generic. It doesn't know, like on a day like today, that getting long might not be a good idea currently. You can learn that. What's the Holy Grail? Well, there is no Holy Grail. I'm sure you've been looking for it. It doesn't exist. And I know for myself what I did many years ago. I thought, if I'm going to find what other traders have not found, I'm going to put this package of indicators or custom things that I built together, and I'm going to extract the thing that everybody's missed. Well, let me suggest this to this astute group of traders. Do you think enough traders have already walked in your shoes attempting to do the same thing and are no longer in the business? Why is the failure rate so high? Is it possible that the process they're seeking, the risk avoidance and the confirmation, doesn't exist? I'm just asking you the question. Maybe it'll exist for you, but statistically, maybe not a sustainable idea. Day trading, fantasy versus reality. Stop gambling, start winning. What about multiple time frames? I get questions about that. Watch that one. Are you trapped in trader Groundhog Day? That was me. Work hard, wake up in the same place. Random winning trades. Trading high volatility reports. Have you ever done that? Gaps and trend days, and a lot more. VPOC migration, fractals. This is a bit advanced, but you might find it interesting. Auction-based trading on display, something you're seeing here. And there's a lot more. And then a document section, a lot more here. Audio, understanding mental obstacles. How's yours? And then the best videos, 22, 23, 24, and some of them up to 4 hours long of real-time narration in different configurations. And again, guys, I don't want to really encourage you to come to Trader Lab unless you're willing to accept that maybe what you're doing, in spite of your effort, is, let's just say, misplaced. And the reason for that is we have these random winning trades, and we're going to try to make it work because of our beliefs. Notice what I mentioned to you. This is not about being right. Liquidity here, sweep, iceberg, see them? Why did it go up? Because the market goes down for liquidity, so the limit, and there's the stops, to go up. Now, this may sound like I'm saying is, I'm telling you I'm right. There is no right. What I'm sharing with you is market mechanics. If you understand how the market works, you can't predict what it'll do, but you can understand where behavior might take place. I understand behavior might take place here, but because of the stops that are here, this is what I was looking for. There it is. Now, where's my next trade? Way in advance and not a recommendation, out here. Right? If you understand how the market works, it's not that any specific trade is going to be a profitable trade. We're all going to take stops, so we have to detach ourselves. But we might, if it comes out and squeezes, remember the market is short. What does the market do? It goes up to go down and goes down to go up. It goes down to go up. Who's it going up on? The shorts in here, the shorts in here, the buy stops are sitting here. This is a weak high. Why, you're going to ask me? Because of retail trader behavior. What do? They're lemmings. No offense. What do? Oh, they piled their stops right here. Does this look like a strong high to you? Or is this a weak high? This is weak. Why is it weak? Because there's going to be stops piled here. What are stops? Market orders. What does the market tend to do? Come into the stops. What did the market do coming this way? Go into the stops. What happens when I go into the stops? I get absorption. What might happen up here and out here? Absorption. What does that set up for me? Reversion. See? If you know that, you have to know you have an edge. I'm not saying anybody should trade that. I'm saying is you would know it. And if you know it, you're not sitting here going, what should I do? Have you ever considered, and this is just a question, that you don't make it up here? You already know what you will do. not where it'll happen, but what you will do before it happens. Have you ever thought that what this business is bringing a plan to the market and then adjusting it based on what the market tells you? The market gives you information. Then you have a plan that's already vetted for the current condition. And you know what you will do. You know how to manage a trade. You know where to put the trades on. You know how to trigger the trade. You know how to get risk neutral. You know how to target the trade or manage the trade, trailing stops in some specific configuration that is statistically proven. And it's no longer up to you to do anything other than follow that plan. You're not making it up here. You're not asking, what should I do? All the questions are answered because the market is random. You need to have the answers before you put the first trade on. If you have to ask, what should I do? You don't have a plan. You're now being controlled by your fear and greed. Because when you don't have a tangible plan, which is statistically oriented, all you have is emotional stimulus. Chemicals are going to be released in your brain, fight and flight, FOMO, and the rest of it. Do you understand this? If you don't understand it, you need to come to Trader Lab because this is what will take you out of the business, not having a trade plan. I know we all want to click the button and have a great time. I get it. But that's entertainment, you know? If you want to be in the business, be in the business. If you want entertainment, go to the casinos. You know it's entertainment, don't you? Get the cocktails and the ticket to the buffet, go with your friends, and hang out and have a wonderful time. Throw whatever amount of money you're willing to lose down on the table and play. This is business. So if you're going to treat it like a video game or a hobby, great. That's okay. That's a choice you make. But you have to acknowledge that you're making a choice. I choose to be in the business, and the traders in Trader Lab have made a choice. Now, it's going to require work. It's going to require you overcoming the habits you've formed and the beliefs you hold. It's not easy. Trust me on this. There's no magic solution. You're going to have to roll your sleeves up. If you want to compete in the highest levels against the best minds on the planet, you're going to have to do something different than what most retail traders do. There's no secret sauce, no love potion number 9, no only one thing you need. You go out on YouTube world or the internet, I hope by now you've just thrown your hands up and said, I can't waste my time anymore. That's Trader Groundhog Day. There's no shortcut. If anything, you got to say, I'm going to get educated. I've got to put my time in so I can understand the competition, and I cannot do what other retail traders do. You can learn from what you've done. I call that trapped equity. Or you can keep repeating the course. That's trapped equity. So you can make a choice, and I'm not saying Trader Lab's the solution for you because it's going to require you to do work and become a business manager. You have yourself as the owner of your trading business, and you have the trader inside yourself that you must manage. Discipline. Have meetings with. Review your journal. Extract metrics. Yes, work. It is not a video game. It is a preparation for a strategic endeavor where you must do what others are not willing or able to do. And no matter what you do, it doesn't mean you'll be able to create sustainability. But the biggest obstacle to sustainability in this business is going to be you. Doesn't matter. It's going to be you. I believe anyone who comes to Trader Lab can learn how to trade if they do the work. It's a community effort. We help each other. There's a lot of work to be done, but it's not complicated. You know how to shop? You already have the chassis of trading, because that's all trading is shopping. What is difficult for us is randomness and uncertainty. If you have an edge, you can become certain that if you execute it, and I mean you've done the work, you have an edge, and then you execute it, you can be certain if you follow that process, you can become profitable. The obstacle for you is going to be overcoming your fear, looking for certainty, and responding productively to the inevitable losses that are overhead and cost of production. That's it. Interested in Trader Lab? Use the link in the bottom of YouTube. And don't forget, Bookmap not only has made a material investment in this high-tier order flow tool that you see here every day, it's the tip of the spear, but they also have made an investment in trader education, and it's available to everyone at no cost. Is there any other company you know that is investing in you? It's not a paid chat room. There's nothing going on, no secret sauce, no nothing, no little vendor links at the bottom of anything. It's all free. Now, that may or may not resonate with you. It certainly resonates with me because I don't know any other company that invests. And yes, is it altruistic? No. What is it? It's good business. It's good for them because if you can become successful, you'll become a client and a subscriber. Wouldn't you? So we're all aligned in the same place. They invest in you, you invest time, and maybe you can learn to build a business. You then will use a high-tier product. Isn't in their interest? And how much have you paid for education over the years? Well, I don't know. But where can you get education like this at no cost to you? And you don't have to even be a Bookmap subscriber. The idea is if you can sustain yourself, maybe you will. How does it get any better than that? Now remember, not a recommendation. What was happening while this stream is going on? This. What did I suggest? Now, it doesn't mean it'll do it. I'm not saying I know anything. I'm saying is I know what might happen. I know why. That's auction mechanics. I know why. I know where. I don't know if. The next thing I know is, where's my stops? Here. Do I want to be short in this? No. Do I want to get long? Not me. Doesn't mean that it wouldn't be a profitable trade. Well, if I anticipate it's going to come back here, you're going to say, Tom, why didn't you do that? Because I want to be up here to come here and then see whatever it does. Doesn't have to do anything. And just keep going. It's Friday. We might get short covering going into the weekend. And if I put a trade on, if everything lines up and I take a stop, does it matter? No. Now, to you, it might. Why would it matter to me? Because it's a sample. It's just one trade. But if I had my shorts from up near the high of the day today, here, I'm okay with this. Would you be? You see? So it's overhead and cost of production. So, and emotionally, I got to tell you, the hardest thing is not going to be learning the trade. The hardest thing is going to be you. Hope you're getting something out of this. Review this stream over the weekend if you want to kind of take a look at it again. Remember the Trader Lab community. There's a link in the bottom of YouTube. You can visit the Trader Lab, watch some of those streams. If you want to see the real-time narration, these 4-hour streams, there's a bunch of them in there. They're a couple years old. I'm a full-time trader. I just don't have time to do this as it is. A lot of these trades I narrate, I'm not able to take them while I'm streaming. So that does give me a little indigestion. But I'm pretty good with what I do. Part of the reason I decided to create Trader Lab was what I went through in my learning curve. When I started, there was no information. There were no indicators. It was all new. So my curve was a lot different. I shared an office with George Lane. He created Stochastic. I thought that was the holy grail. Why wouldn't you? Well, spent a few years trying to get it to work right and be consistent, and it doesn't in spite of the winning trades. Eventually, and I'm a slow learner, the light bulb goes off. I hope the light bulb goes off for you and that being here today has shed some light on trading. And maybe if you're not getting the consistency, maybe something you can do to potentially change your outcome. Please give a like on the way out. Appreciate your time and interest in Trader Lab. Feel free to forward this, copy the link and forward it to your trading friends if you think they might benefit from Trader Lab. Have a super weekend. Look forward to seeing you next week. And don't forget the like. It's one way you can kind of pay it forward, support the Trader Lab.